Whatever's going on, this is not a normal bull market. Gold and silver are not simply keeping pace with the rate of inflation at 2% a year. Absolutely not. Gold and silver are front-running what they see might be coming down the line. What they see is potentially a massive monetary expansion as governments move to pay off their debt through newly printed money, potentially leading us to a very high inflation rate or even worse.
For most of modern financial history, gold and silver have not been emotional markets. They do not react to headlines, political speeches, or daily economic noise. They move only when something fundamental is breaking beneath the surface, when the architecture of money itself begins to distort. That is why moments like this demand attention, not because prices are rising, but because of how they are rising and what kind of stress must exist beneath the global financial system to produce moves of this magnitude. What we are witnessing now in precious metals is not inflation hedging in the traditional sense. It is not a slow repricing against a measured increase in consumer prices. Gold is no longer climbing patiently over years, and silver is no longer lagging quietly behind. Instead, both metals are accelerating in sudden, violent bursts, price behavior that historically appears only when confidence in currency begins to fracture. These are not speculative flows chasing momentum. These are defensive moves made early by capital that senses instability long before it becomes visible to the public. Gold making triple-digit daily moves and silver breaking higher in percentage terms unseen in modern markets is not simply extraordinary, it is unprecedented. In prior monetary cycles, even during periods of high inflation, precious metals rarely behave this way. The scale, speed, and synchronization across metals point to something far more serious than rising prices at the supermarket. They suggest that markets are beginning to price a future where debt cannot be managed honestly, where monetary expansion becomes the only remaining political option, and where fiat credibility erodes quietly before collapsing suddenly. In this video, we're going to walk through that process with the help of Clive Thompson, a longtime market analyst who has been closely tracking the breakdown now emerging across global bond markets and currency systems. His analysis does not focus on hype or predictions, but on structural signals, the kind that appear only near the late stages of monetary regimes. Stay with me, because the most important part of this story lies not in the price charts themselves, but in the stress now spreading beneath them. Before we dive into Clive's analysis directly, take a moment to support the channel by liking the video and subscribing if you value serious macroeconomic commentary without noise or sensationalism. These discussions matter most before the cracks become impossible to ignore. And once you hear what Clive is seeing, you'll understand exactly why.
Are we witnessing the end of fiat? We are witnessing history in the making. Forget everything else for a moment and look at the precious metals markets. We are seeing daily moves that are simply staggering. Gold is making $100 jumps, almost routine. It's smashed through the $5,000 ounce ceiling, except it wasn't a ceiling because it just kept going and going. And the real story, today at least, is about silver. It's on an absolute tear. When I looked earlier today, it was up about 5.8%, breaking through $109. I repeat, up 5.8%. I think it's probably gone higher since. We're going to look at that in a second. Platinum and palladium are being pulled along by this explosive ride. Now let's go straight in and look at what's happening to the price of silver. Here we see the price of silver straight away, and I can't believe my eyes. I'm seeing a price of $112.70, up over 9% on the day. It says it's up $9.30. That's kind of off the radar screen. The Shanghai price, which I just click on now, it's up at $127. There we are, $127. That's about $14 higher than the price in COMEX. That's an all-time record as well. The near-dated future in COMEX is at $111, which is slightly below the spot price of $112.80. So it looks like silver has gone into backwardation, at least for the near-dated contract. Gold is likewise soaring. We'll look at the gold price here. It's up over $118 today at $5,153. $5,100, up $117.64, it says, or up 2.37%. Platinum, we're looking at here, that's $2,809, up $75 on the day, 2.78. Palladium is doing well, up $102 at $2,843 or 3.74%. I'll just pop back to silver, which is now trading at $112.90. It's on an absolute tear. And if I look at bring the chart, let's just make that get that all on the screen to scaling here. If I bring the chart here, you can see that it looks like, if I go tighter here, it looks like the silver price is going parabolic. The same can be said of the gold price if we look here. About a year ago, I sat here and talked about what the end of the fiat system might look like. I suggested that we wouldn't just fall off the cliff one day, wake up and find that nothing exists anymore, but I said we might see a final face-ripping melt-up, a huge rally in precious metals before the system breaks. I said we might see a period where asset prices seem to go parabolic as confidence in the currency evaporates. Well, take a look around. What we are seeing now in the gold and silver markets, and even the stock market to some extent, looks a little bit like the melt-up I described might happen. Now, whatever's going on, this is not a normal bull market. Gold and silver are not simply keeping pace with the rate of inflation at 2% a year. Absolutely not. Gold and silver are front-running what they see might be coming down the line. What they see is potentially a massive monetary expansion as governments move to pay off their debt through newly printed money, potentially leading us to a very high inflation rate or even worse. So this is a flight from currency. Now, one of the things which might be triggering it at the moment is emanating from the other side of the world. And I don't quite know how that fits in, but I'm going to describe it to you, and maybe some of you can see how this is impacting the precious metals market. For many, many years, even decades, there's been a seemingly free lunch available to large hedge funds and large banks. Not to you and I, but that free lunch is known as the Japanese yen carry trade. In the Japanese yen carry trade, large banks or hedge funds would borrow billions, even trillions, of Japanese yen at near zero interest rates. And they would invest that money in higher yielding assets, such as US treasuries or Brazilian bonds or the stock market. It didn't really matter where they invested the money. Borrowing Japanese currency seemed like a free lunch bet because, one, the Japanese yen was likely to continue falling, and two, the interest rate that you were paying on the loan, the money you borrow, was effectively zero. So you just had to invest in almost anything and you could make free money. And as long as the yen stayed weak, it was like a free money printing machine. But that free money machine is starting to break down. For many decades, the Bank of Japan has been trying to create inflation because Japan's been in deflation. It's finally got its wish. And inflation is running hotter than they can handle. To fight it, the central bank, the Bank of Japan, is being forced to abandon their zero interest rate policy, ZIRP. They're being forced to abandon ZIRP. And what's happening? We're seeing a violent sell-off in Japanese government bonds, known as JGBs, Japanese government bonds, and that is sending yields in Japan soaring upwards.
For decades, Japanese government bonds were synonymous with calm. Yields barely moved, volatility was negligible, and the yen became the world's preferred funding currency. That stability allowed global investors to borrow cheaply in yen and deploy trillions into foreign assets, a mechanism known as the yen carry trade. which quietly underpinned global liquidity for more than 20 years. That stability is now unraveling at remarkable speed. Last week, ultra-long Japanese government bonds suffered their most violent sell-off in decades. 30-year yields surged by 0.25 percentage point in a single session, something virtually unheard of in the modern JGB market, while 40-year yields pierced 4% for the first time in history. This was not routine volatility. It reflected growing fear that Japan's fiscal trajectory is colliding head-on with the Bank of Japan's ability to maintain control over its bond market, particularly as political leaders pursue aggressive spending and tax cuts despite an already enormous debt burden. Foreign investors now dominate long-dated Japanese bonds, and unlike domestic buyers of the past, they are highly sensitive to price risk. As yields rise, bond prices fall, and with inflation now embedded in Japan's economy, the era of guaranteed stability is over. What was once the world's safest funding market is beginning to behave like a stressed one. And when that happens, it forces a global recalibration, because Japan is not just another bond market. It is one of the pillars holding up the entire post-2008 financial system. This is where Clive Thompson's analysis becomes especially important, because the turbulence in Japanese bonds does not remain isolated. It feeds directly into currency markets, global liquidity, and ultimately the rush now unfolding into precious metals.
Now, this is causing some kind of panic for those who are at the wrong end of it. As Japanese interest rates rise, the carry trade is starting to unwind. Investors who've got global assets are thinking about selling them to repay the loans they've taken in Japanese yen. Why? Because the interest rates have been rising. So let's have a look at the Japanese yen interest rates now. So I'll just cross over to here, the browser, and we're going to go to the Japanese interest rates. Bond yields, Japan 3-month. So here we see I'll go back a picture. Back in 2019, we see interest rates are negative. You can see it's minus 0.1, 0.2%. Negative 2020, 21, 22, 23, 24. Interest rates were negative. Then in about the middle of the year in 2024, interest rates rise from negative to 0%, and they keep rising. And so what we've seen is, since the middle of 2024, a gradually rising short-term interest rate. This is a 3-month bond. And we now see that the yield on that 3-month bond is 0.77%. It's not free money anymore. If you borrowed Japanese yen, you'll have to be paying at least 0.77% and some with the margin. But it gets worse if you look at the 2-year bond. The 2-year bond, which also for many, many years had a negative yield, right through until 2024, beginning of 2024, started to rise rapidly, and it's now 1.27%. The 10-year bond, same story. The yields were negative, and the yield is now going from 0% up to 2.38%. And the 30-year bond, where the yield was about 0.6% here, actually it was 0.1% at one point, but let's call it 0.4% there, yeah. Call it 0.6% by about 2022. That's risen to 3.6%. At one point today, 3.93%. So Japanese bond prices are falling, which means that the yields on those bonds are rising. Now, unwinding of the Japanese yen carry trade could mean that people are forced to do all sorts of strange actions. We don't know exactly what's going on, but that might be a factor at play. Now, let's come back to the metals, and just going back to gold, let's go back to silver here. Oh, my goodness me, it's now $113. So why is the melt-up in metals accelerating at a faster pace than justified by consumer prices? I think what's happening is people are front-running a possible future loss of confidence, a future loss of trust. Have a quick look at this. So, inflation here is at 2%. Are people expecting a mammoth spike in inflation a few years down the line and they're front-running it? It could be. And what happens when inflation soars? Well, we're looking here at some banknotes from Yugoslavia back in the 1990s. It was about 1994. Inflation became so high that the prices were doubling almost every single day and a half. People who were earning money daily had to immediately rush to exchange it for food or anything else, Deutschmarks for example, before it became valueless. So what you earned yesterday would already be valueless by tomorrow. That's what happens in a hyperinflationary environment.
The deeper issue emerging from Japan is not merely higher yields. It is what those yields represent. For most of this century, Japan exported capital to the world. Trillions of dollars flowed outward, suppressing yields in the United States, Europe, and beyond. That capital helped inflate asset prices globally, while allowing governments to borrow far more cheaply than fundamentals would normally permit. If that flow reverses, even partially, the consequences are enormous. Already, traders are beginning to confront a new reality. As Japanese yields rise, domestic investors have a growing incentive to bring money home. Roughly $5 trillion of Japanese capital remains deployed overseas, not including the yen borrowed by foreign institutions to fund speculative positions worldwide. A sustained shift in yield differentials could trigger forced selling across global bond and equity markets. Not because investors want to exit, but because funding conditions are changing faster than portfolios can adapt. This is why gold and silver are reacting now, not later. Precious metals do not wait for official confirmation of crisis. They respond when confidence begins to thin, when markets sense that policymakers are losing optionality. The violent repricing we are witnessing suggests that capital is already front-running a future where debt monetization becomes unavoidable, where currencies compete to devalue, and where trust, once lost, cannot be easily restored. When Clive Thompson describes this as a flight from currency, he is not speaking metaphorically. History shows that monetary systems rarely collapse in a single dramatic moment. They fracture gradually, then suddenly. The early stages look like asset meltups, parabolic price action, and dislocations between markets. Exactly the conditions now appearing in gold, silver, and global bonds. By the time the full picture becomes visible to the public, the opportunity to respond rationally has often already passed. If this truly is the final phase of the fiat experiment, it will not announce itself politely. It will emerge through stress, through yields that move too fast, currencies that behave erratically, and metals that rise not out of greed, but out of fear. And that is why these price moves matter far more than their numerical value. They are not signals of prosperity. They are warnings. If you found this analysis valuable, please like the video, share it with others who follow global markets closely, and subscribe to the channel for continued deep dive commentary. Thank you for watching, and as always, stay alert, stay informed, and I'll see you in the next one.